For valuing growth stocks, the math is different than you would use for a value stock. A growth stock starts from some value and then has a massive growth period until the growth slows down to maturity. In a growth stock, we're valuing the future sales and the future dividends, and we're trying to make some assumptions of what it might be in the future when it starts returning the earnings to shareholders. So the math is different. For the growth company, assuming, let's say, for example, it's 30%, we're going to use price to sales, and we're going to ramp up or factor up the sales by some number, usually the sales growth. So we're going to assume that the sales this year, well, they're going to grow by that percentage next year to 1.30 because it's going to grow 30%. And then that's going to grow by 30% to 2.60. So this is already 2 years out. And a lot of things can happen on the way to the future. A recession, a change in economic conditions. But of course, these are just assumptions. These are just ways to measure and kind of price in and anticipate the future growth. The rule of thumb that I use, because if you calculate this in a calculator, it'll give you some function. If you backtest these numbers, if you look back at the FANG stocks, you'll get these numbers as well, and you'll see that they do work. But if you compound 1.3 eight times on a calculator, you'll get a little bit more than 8x or 800% in 8 years. So I usually say 800% in a decade. That's what I usually use as a baseline. There are some companies that grow faster than 30%, and there's a lot of companies that grow slower than 30%. So then we get to the PEG ratio. The PEG ratio is the PE over growth. The PEG ratio. It is a tool that investors have used for a long time to figure out how much someone should pay for a company. And it's quite useful because you look at the PE and you factor in the growth and you compare them to each other, and you'll get some range that will give you some judgment or some observation of value. Investors like to pay below 1 time PEG, or a PE, in our case, below 30. If we know the stock is growing or has historically grown or is expected to grow at 30%, we're comfortable paying below a PE of 1, and we would love to buy it even lower than a PE of 30. PEG of 1, PE of 30. If we can get it for 15, that would be great. Apple was bought by Warren Buffett when it had expected growth of 30, and the PE was only 15. So that's a PEG of 0.5. And then what happened is we had a big run up, and the PEG went up to 2, and that stock quadrupled in not a lot of time. When it gets to PEG 2, it starts to get priced in, and that's why we call it perfect pricing. If this PE becomes a 60, we're now paying 2 times growth. If the PE goes to 60 and the growth is 30, that's a 2 PEG. Okay, so some people would sell, some people would hold, some people would use a stop loss. It really depends on people's risk profile, but they would have to wait then for the company to grow into the now high valuation, and then they risk a sell-off. However, if you want to make it to 8 times in 8 years, you're going to have to hold in these high valuation times and risk a sell-off, or maybe you don't. It's really up to you, but it's going to take 8 years to get the maximum benefit of all that growth over time. Over here I show you the PEG of 1 or a PEG of 2. Okay, so that's what we spoke about, 60 and 30. And I just want to remind you that this is oversimplified. Profits matter. If a company has a low profit margin, this is not likely to occur. They're not likely to get a PEG of 2. If it's too big of a company, also hard to get a peg, a high valuation like this. And it also depends on the industry. But this is the model this is the model that high growth companies seem to trade on in good markets with low interest rates. If in high multiple market, this seems to work. In a low multiple market, we're closer to value model. In the value model, you're just going to take earnings and divide it by some interest rate, and you're going to value the stream of cash flows. So I hope this is useful.